Let me call the hearing to order. My ranking member, Senator Crapo, is delayed. We anticipate that other colleagues will be arriving shortly, but since the panel is assembled and the time has come and it's appropriate to begin the hearing, let me welcome everyone to the hearing. It's a very important topic, examining the IPO process. Is it working for ordinary investors? I've had the opportunity to read your testimony, and let me thank you all for very thoughtful and insightful comments. I appreciate it, and I look forward to the questioning. The number of individuals participating in our capital markets has grown substantially, especially for investors trying to save for retirement through their 401k plans and other retirement plans. Once an opportunity that was limited primarily to institutional investors, now the chance to participate in initial public offerings is increasingly available to ordinary investors. The essential question I want this hearing to answer: is the system fair and transparent, and is it working for everyone, particularly individual investors? A dysfunctional IPO market can harm our economy. While the summer is typically the peak season for IPOs, in the wake of Facebook's highly publicized IPO troubles, which was marred by technical mishaps, many planned IPOs have been postponed or canceled, and more Americans and the investment community are questioning the integrity of the IPO process. And frankly, I think we all recognize that without confidence by investors, the ability to efficiently form capital and to generate jobs is impaired. That confidence is fundamental to our free market system. Regulators continue their investigation to some of the specific problems surrounding the Facebook IPO. This hearing is a chance to broadly and publicly examine the procedures for taking a company public. That's one data point, but it's a much, much broader set of issues that we want to confront this morning. There's also concern that the Jobs Act, recently passed, made some of the biggest regulatory changes to U.S. capital markets in decades and weakened some key investor protections. It may have caused some other new problems, such as allowing more shell companies for reverse mergers to go public in the United States. Indeed, a recent Wall Street Journal article quoted special purpose acquisition companies and blank check companies, basically empty shells with almost no employees that are used in mergers or as a backdoor route to U.S. stock listings, have been quick to identify themselves in regulatory filings as, quote, emerging growth companies. The new law uses that label to describe which companies, once they've applied to go public, should be exempt from some financial reporting and corporate governance rules. Companies with less than $1 billion in annual gross revenues are eligible for the less restrictive rules, a standard that would have been met by a majority of companies conducting an IPO in the last several years. So this is a very high threshold, obviously. Companies that qualify as emerging growth companies don't have to comply with the Sarbanes-Oxley Act's requirements that auditors review their internal controls. It also allows them to make fewer financial disclosures, use a new confidential SEC review process for IPOs, and lets their bankers communicate more freely with selected investors, the more sophisticated players and investment banks. Underwriting the IPOs of emerging growth companies is a big business on Wall Street. Investment banks are expected to take full advantage of the new, less stringent requirements. As a result, retail investors may be denied critical information that is essential to making sound investment decisions. Unfortunately, during the expedited process used to pass the Jobs Act, improving the efficiency and transparency of the existing IPO system was not really discussed. With full and fair information for investors, our capital markets are more efficient and transparent and can better facilitate the capital formation so important to our nation's economy. Clearly, all investors face certain risks when contributing capital to either small or large companies. In fact, the panelists made the case quite clearly that risk is inherent in all of these IPOs, and that should be acknowledged. However, we need to ensure that there isn't one set of rules for sophisticated Wall Street clients and another set for ordinary investors. Everyone should have access to the same set of data and disclosures, or at least equivalent data and disclosures. Chairman Johnson has instructed committee staff to conduct its due diligence regarding issues raised in the news about Facebook's IPO. This hearing will be part of that, but again, the focus is on the broader issue of IPOs. And then he has stated that once these briefings have concluded, we will determine if a full committee hearing is necessary. So today's hearing will serve as a jumping-off point, broadly examining the procedures for taking a company public, and I think it'll be a very productive hearing. When Senator Crapo arrives, if he is able to arrive, or my colleagues, if they wish to make an opening statement, I'll interrupt your statements and give them that opportunity. But let me now proceed to introduce the witnesses and then ask for your statements. Our first witness is Dr. Ann Sherman. Dr. Sherman is Associate Professor of Finance at DePaul University. She received her PhD in economics from the University of Minnesota. Dr. Sherman's research on IPO methods has been published in top finance journals, and she was a consultant on the Google IPO. Dr. Sherman has taught finance at the University of Wisconsin-Madison, the University of Notre Dame, and Hong Kong University of Science and Technology. Our next witness is Ms. Lise Beyer. Ms. Beyer, Liz, forgive me, is the founding principal of the Class 5 Group, an organization providing strategic and logistical guidance to companies contemplating an initial public offering. Ms. Beyer has firsthand experience as an institutional investor, investment banker, venture capitalist, board member, and internal IPO coordinator, analyst, and employee. Previously, Ms. Beyer was the director of business optimization for Google Inc., where she was one of the chief architects of the company's innovative IPO. Our next witness is Mr. Joel H. Trotter. Mr. Trotter is a partner at Latham & Watkins and is the global co-chair of the firm's public company representation practice group and the deputy chair of the corporate department in the Washington, D.C. office. Mr. Trotter's practice focuses on capital markets transactions, mergers and acquisitions, securities regulation, and general corporate matters. Thank you, Mr. Trotter. And finally, our last witness is Mr. Ilan Moskovitz. He is a senior analyst for the Motley Fool, a global financial service company and tireless advocate for individual investors, specializing in financial reform, macroeconomics, and shareholder rights. Mr. Moskovitz's research has been cited numerous times in the national press. We thank you all for being here. All of your testimony will be made part of the record in its entirety, and I would ask you to summarize it within 5 minutes. And we'll begin with Dr. Sherman. Dr. Sherman.
Chairman Reed, thank you for inviting me to testify today. My research has been primarily on IPO methods in various countries, and in the last 3 decades, there's been a lot of experimentation in various countries with different methods. Now, one of the main points I want to make today is that the US method, commonly called book building, is the most popular method around the planet. And it wasn't always that way. If you go back to the early 1990s, it was used really only in the US and sometimes Canada. By the end of the 1990s, it was the dominant method, and it's become even more popular since then. Now, the difference between book building and the other methods is that with book building, the underwriter gets feedback from investors before setting the offer price. And it's not always easy to get people to honestly tell you that they like an offering if you know that you're going to use that information to raise the price. And that's why it's important that the underwriter also controls allocations, who gets what. So by controlling allocations, the underwriter can favor regular investors that don't just try to cherry pick the hot offerings, can favor investors that give feedback that help to set the price, and can favor long-term investors. So there are reasons why the underwriter may favor institutional investors. Ordinary investors may not have the expertise or resources to play the same role in an IPO. Now, that doesn't mean that they can't participate. If you look around the world, most countries open up the IPO process to all ordinary investors. But the key is that they open up the allocations, but they do not control the price setting. The ordinary investors don't help to set the price for IPOs, they just get a chance to get shares. So the most popular method outside the US is a hybrid or a combination where they have a tranche that uses book building, and they use that to set the price and allocate to institutional investors. And then for ordinary investors, they have a separate tranche. Ahead of time, it's announced what proportion of shares will go into each tranche, and everyone is allowed to order shares in the retail tranche. And if it's oversubscribed, they have basically a lottery. So it's open, it's transparent, everyone has a chance to get shares, but they don't disrupt the price-setting process. That's the method that has worked well around the world. The method that has not worked well around the world is to use an auction that's open to everyone so that everyone has an equal say in setting the price. I don't want to use up too much of my introductory time, but I'd be happy to answer questions on that. The auction method has been used in more than 24 countries, And they've pretty much all abandoned it because of huge problems. When I was doing literature searches or newspaper searches to find out more about various IPO auctions, I learned that good search terms were flop, disaster, debacle, catastrophe, calamity. The auction method is one that is blown up in people's faces around the world, which is why countries stopped using it. Retail investors should be allowed to participate, but you have to be very careful about giving them a major role in the price-setting process. So what should the U.S. do? Frankly, I'm neutral on whether the U.S. should require issuers to give a bigger role to ordinary investors. But I feel strongly that if we're going to do that, it should be through the hybrid method with a separate tranche so that everyone has an equal chance of getting shares, but it doesn't disrupt the price setting. Last, on the role that small investors should play in private equity, and in particular crowdfunding, where you have maybe a website and a bunch of people put up a few $100s each, I see two big problems with that. The first is who's going to do the due diligence. Fraud is a major problem with these. Someone needs to screen these offerings before they get funding, and someone needs to continue to monitor them. And if we don't find a way to do that, crowdfunding could be a disaster for ordinary investors. And the second question is who's going to set the price? I hope that I've communicated that letting ordinary investors price IPOs has been disastrous. And if they're not good at pricing relatively sophisticated or advanced IPOs, then there's even less reason to think that they can price early stage startups. Again, thank you, and I'd be happy to answer any questions.
Thank you very much, Dr. Ms. Byer, please.
Chairman Reed, thank you very much for inviting me to be here today. I'm honored to be able to submit my commentary to such an important discussion of the IPO process, which is clearly such an important rite of passage for so many companies. Having been an institutional investor responsible for deploying the assets of aggregate individuals, an investment banker, part of the team that designed and implemented a unique and high-profile IPO, and a board member of a company as it transitioned from private to public and then afterwards, I've looked at the IPO process from a variety of perspectives, and it is from that combination of perspectives that I offer my comments today. IPOs, as you mentioned, are always and inherently very risky, riskier than investing in seasoned companies. In fact, if we look at the class of 2012, as of a day ago, the best performing IPO year to date was a Buffalo, New York-based company, Synacor, which had a very difficult time getting public, traded up 5% day one, and now is up in an incremental 162%. Then there's Cirrus, which was warmly embraced by the market in its IPO in February, up 14% day one, currently down 31%. And then there's the higher profile Splunk, which was up 109% on the day of its IPO. Today is up 90%, meaning that those people who participated in the frenzy of day one may be underwater, even though the stock has nearly doubled from its initial public offering. The point of that is to say it's very difficult to predict what any stock will do on its IPO. And in fact, there is no right answer. There are always winners and losers. So I believe that, in fact, the people who invest just day one are really speculators, not investors. Investors need to be in for a longer period of time. I believe the importance here is for overseers to make sure that up front, anyone who chooses to participate in an IPO fully consider not only the possible rewards, but also the very, very real risks. And in fact, if I may make only one suggestion here today, I would suggest that before confirming an order, be it by phone or in person or online, every individual be asked to read or be read to, acknowledge, and confirm agreement with a very short, simple, bold statement along these lines. I fully acknowledge that this stock has an equal chance of trading up or trading down from my purchase price. And furthermore, I acknowledge that shares of newly public companies routinely trade below the prices at which they are initially offered. My hope is that a cigarette box type warning of this nature could just add a moment of pause to transaction decisions that are too often based on emotion and not on thoughtful analysis. With my remaining time, I would add two other comments. First, as we know, some institutions have the chance to meet with management teams to see a presentation and ask them questions during a roadshow. Clearly, it's not possible for individuals to have that same exposure, although with the advent of the Retail Roadshow, they now have the chance to watch the presentation, even though I suspect most of them don't. I wonder if there's a chance to level the playing field by suggesting to companies going public that they add an hour, or they offer an hour of Q&A, online Q&A for individual investors, during which time they could respond to pre-submitted questions from any investor who had actually watched the Retail Roadshow. Just a chance to level the playing field. And finally, a third comment I would make echoes what you just said. I have significant concerns about many of the provisions of the well-intentioned, recently passed Jobs Act, as these provisions reduce transparency and really roll back important, in my opinion, investor protections. I would suggest that that act may need some refinement. The question inferred in our initial invitation, which Dr. Sherman just addressed, in the pricing and allocation, based on my years of watching IPOs, I would suggest that that needs to be completely in the hands of professionals who have a fiduciary obligation for those whose money they are overseeing, the management of the company selling stock, and the investment bankers who have the best aggregated information about the market and about interest in the particular security. I do not think it is appropriate for retail to be able to set the price in IPOs. So in summary, I think generally the process works very well both for companies and for informed, and I would underline informed, investors. I would recommend, one, that we add a request for a signed, straightforward acknowledgement of risk. Two, that perhaps management teams offer a Q&A session for individual investors. And three, that we revisit the provisions of the Jobs Act. Thank you very much.
Thank you very much, Ms. Bide. Mr. Trotter, please.
Thank you, Mr. Chairman, and my thanks. Thank you, Mr. Chairman, and my thanks also to Ranking Member Crapo and the other members of the subcommittee and their staffs. I've provided you all with detailed information in my written testimony and want to highlight 4 key areas that bear emphasis. First, the national importance of our IPO markets. Second, a bedrock principle of our system of federal securities regulation, which is disclosure, not merit regulation. Third, another bedrock principle, which is the concept of materiality in that disclosure. And finally, I want to comment on the nature of risk, reward, and capital formation. So the first point I'd like to make is that IPOs must compete with other forms of capital formation. Emerging growth companies have 2 alternative paths for providing liquidity to their early-stage investors. They can either pursue an IPO or they can pursue a sale of the company. An inhospitable IPO environment sends more early-stage companies toward a sale process and away from the IPO alternative. And that's exactly what we've seen in recent years. This matters a lot because IPOs play an important role in fostering innovation and job growth. As President Obama said when he signed the Jobs Act into law, new businesses overall account for almost every new job that's created in America, and going public is a major step towards expanding and hiring more workers for those companies. The IPO on-ramp in Title I of the Jobs Act is an important step in making it easier to go public while maintaining important investor protections and providing significant cost savings in the IPO process. The second point I'd like to address is what else we can do to help IPOs. We can return to bedrock principles of federal securities regulation. From the beginning, Congress has mandated a disclosure regime rather than merit regulation. My mentor and former partner, John Huber, used a memorable anecdote to contrast disclosure with merit regulation. John is well known for a distinguished career and his distinguished service as director of the SEC's Division of Corporation Finance, a disclosure regulator. But earlier in his career, he had worked for a state securities commission, a merit regulator. His co-workers at that state commission proudly refused to approve the shares of an untested upstart company whose name today everyone in this room would recognize. They had rejected that company's request to sell shares to residents of their state because the CEO's compensation was too high. What was the IPO price, John asked them. Answer, $22 per share. Well, John responded to his colleagues, the stock is now trading at $60 per share, so how exactly did we help investors in our state by preventing them from buying at 22? That anecdote sums up merit regulation, and it highlights the benefits of a disclosure regime that lets investors choose the winners and losers. The third point I want to make is about disclosure and what information companies must provide to investors in a regime that takes the path of disclosure rather than merit regulation. The tried and true answer to that question is that disclosure of all information that is material is required. Well, anyone who has looked at an IPO prospectus recently may wonder whether we've gone far afield from that central principle of disclosing material information. An IPO prospectus today is a lengthy and detailed document running as much as 200 pages or more often. Brevity may be the soul of wit, but it's hardly the hallmark of an IPO prospectus. A balanced and reasonable approach to materiality is critical to the success of any disclosure-based regulatory regime. An avalanche of trivial information obscures truly important information and does nothing to increase the protections to investors. My last point is about risk. It's a simple fact of economic life that not all IPOs succeed. Any commercial enterprise that can earn a profit can also earn a loss. Like any business, a newly public company may or may not make money for its investors. For precisely that reason, the cover page of every IPO prospectus today says, "This is our initial public offering. No market currently exists for our shares." And the prospectus has many pages of detailed risk factors highlighting the risks that relate to the company and the offering. In addition to transparency, our capital markets must offer investors the opportunity to take risks. Risk-free capital markets have no future, as SEC Commissioner Daniel Gallagher recently said. Even if we could create risk-free capital markets, he said, they would not offer enough upside to attract companies or investors because investors would do just as well or better putting their money into savings accounts or treasury bills. Thank you very much. I welcome your questions.
Thank you very much, Mr. Trotter. Mr. Moskowitz, please.
Mr. Chairman and members of the committee, I want to thank you for the opportunity to offer testimony and recommendations today. My name is Alon Moskowitz, Senior Analyst for The Motley Fool. Founded in 1993, The Motley Fool's purpose is to help the world invest better. Millions of individual investors rely on The Motley Fool not only for guidance on how to manage their money, but also as an advocate for their rights as shareholders. For years, we've worked to create a level playing field in the market. It's for this reason that we are eager and grateful to discuss whether the IPO process is working for ordinary investors. It goes without saying that IPOs are critical to both developing public markets and helping businesses raise the capital they need to grow and hire. From our vantage point as retail investors, the overarching problem with IPOs is that there is an imbalance of both information and access. Although issuers and venture capitalists ultimately depend on us retail investors for capital and for liquidity, the deck is stacked against us in at least two major ways. First, insiders, underwriters, and their favored clients have access to more and better information than do ordinary investors. This gives them an advantage in estimating a company's fair value. Reports of Facebook's recent IPO provide a prominent example of this. Second, there's unequal access to shares. The initial offering is traditionally limited to preferred clients of underwriters. By the time we can buy shares, there's already been a significant markup. It's estimated that from 1990 to 2009, the first day pop averaged 22%, totaling $124 billion. That $124 billion didn't go to the companies coming public, but to friends and other clients of the underwriters. Unfortunately, the IPO process is likely to get worse for individual investors as a result of the recently passed Jobs Act. The on-ramp section of the Act is intended to spur economic growth by lowering the bar that a company must meet in order to go public. But weakening reporting requirements means less information for investors and a lower quality pool of IPOs. Think more Pets.com than Google. When we lost faith in the quality of IPOs in the late 90s, IPO volume crashed 75% in 2001. It's worth pointing out that IPOs doubled from that level following the Global Analyst Research Settlement and passage of Sarbanes-Oxley, reforms which addressed some of the worst abuses of the dot-com bubble in ensuing years. But the Jobs Act undoes many of these reforms for 9 out of 10 companies coming public. To remedy these problems, our objective should be to level the playing field and restore trust in the IPO process by maximizing transparency and useful disclosure. Here are 3 recommendations. First, extend the application and enforcement of Regulation Fair Disclosure to the beginning of the IPO process. This will help to improve the flow of information to all investors and reduce one of the most preventable information asymmetries between underwriters and their favored clients versus ordinary investors. Second, require that companies and underwriters allocate shares in the initial offering in a more inclusive and efficient manner. Companies like Google, Morningstar, and Interactive Brokers have successfully employed variations on a Dutch auction process, which give all investors the opportunity to participate in buying shares at the same price under an equitable plan of distribution. An added benefit is that it lowers the cost of going public for companies by more than half. Finally, fix the most troubling portions of the Jobs Act from the retail investor's perspective. While there are a number of improvements that could be made, if you're looking for the most straightforward remedies, here are two. One would be to decrease the size threshold in the emerging growth company definition in order to increase the amount of information available to investors, as the chairman has previously recommended. The current definition needlessly encompasses virtually all IPOs. A second remedy would be to implement a lockup period covering pre-IPO insiders, which would extend from the offering to at least 180 days after an issuer is subject to normal reporting requirements, similar to common practice before passage of the Jobs Act. This will better align the incentives of insiders and ordinary investors. It will also help to ensure that any capital raised via the emerging growth company exemption serves its intended purpose by flowing to the company and not to insiders exiting on the IPO on-ramp. As the IPO process currently stands, ordinary investors have unequal access to information and unequal access to the market. We're asking for a level playing field, disclosure, and transparency. We believe that the lack of these qualities is what's most troubling about the IPO process right now. I appreciate the opportunity to submit testimony on how IPOs affect ordinary investors and be happy to answer any questions.
Well, thank you all very much for the very excellent testimony, both your written testimony and your comments this morning. Let me begin with a question for the whole panel, and it focuses on the issue of how do we best protect the retail investor, given that the prevailing model, with variations now because of the Jobs Act, is the book building, where managers of the IPO with clients and as the theory, in order to advance price discovery, conduct all these road shows, et cetera. But as the Facebook IPO suggested, is some critical information, particularly at the very last minute, was available to favorite investors and not as widely disseminated to the public. So I just want your thoughts, each one of you, about, you know, if we are going to involve retail investors, how do we do it in a way that they're confident they're getting a good deal and they'll continue to invest in IPOs? Dr. Sherman.
Certainly it's important to level the playing. It's important to level the playing field in terms of information. And I was very surprised with Facebook that analysts were allowed to talk to institutions but not individuals. I can see why that is there, because individuals, if they're allowed to be given these forecasts, because it wasn't hard information, it was expectations of the future, individuals might not understand that these are speculative and they might not be able to appreciate it. But I do think the same information should be available to everyone. One of the unusual things about the US is the quiet period regulation and, as Joel said, this disclosure and not merit. So it's very important that we try to give everyone the same access to information. And I would second what Liz said about the Q&A from the roadshow. I think that should be available even to retail.
Let me just follow up. Is under the Jobs Act, there's a loosening of the analyst role, as I read the act, that they now can be, unlike the universal settlement that Mr. Moskowitz talks about, they now can be sort of compensated, or at least it's not the strict tall wall between the analyst and the promoters of the. Is that accurate from your reading of it?
Mr. Trotter would probably be.
Well, let me just, if you don't know, that's fine.
I don't know.
Ms. Byer, your comments on general question of it.
On the follow-up question or on the whole question?
The whole question.
On the whole question. Number one, let's all remember that individuals do have the ability to participate in IPOs through mutual funds. The favored clients we keep talking about are really those big firms that have aggregated many thousands of individuals' investments. So the firefighters and the teachers all actually do get to participate in IPOs just through the screen of a professional investor. The equal distribution of information is difficult, and I understand this is not about Facebook, but let's remember that everyone had access 2 days before that deal to the information that General Motors was pulling their advertising off. That was a huge material piece of information that didn't seem to in any way quell the enthusiasm. The issue at hand in that particular case was Morgan Stanley's estimate, which of course Morgan Stanley offered to the clients who pay them. The estimate is a product that Morgan Stanley sells to its customers, and I don't know that we ought to be regulating what information customers can share with their, companies can share with their clients. So I think it's a little bit of a slippery slope, and if we insist that all investment banks give their estimates to everyone, what incentive do they have to come up with estimates? I think they'll find other places. So the Jobs Act issue that I find of greatest concern, and you mentioned the global research settlement, is that many banks are still bound by that. So the analysts of the banks who have the most information about the potential IPO are still restricted from talking. The only ones who can now publish research are those who are farther away from what's actually happening, and I'm not sure that that serves anyone's purpose.
Okay. Mr. Trotter?
Well, as I indicated in my written testimony, I'm not in a position to talk about any particular IPO or company, but I will say that in the area of analyst research, by far and away, all of the protections that were developed in the last decade remain in place and are unchanged as a result of the Jobs Act. There were some changes, and many of those changes relating to that area still need to be implemented through FINRA interpretation and other interpretation by the regulators in that area.
Ms. Moskowitz, your comments.
With respect to the global analyst research settlement, yes, that's my understanding as well. One concern with the changes that were made in the Jobs Act is that if you allow analysts to meet with prospective clients, that there's a possibility you can have analysts meeting clients, meeting companies that want to come public, and that way the underwriters can say, hey, here's our analyst. He's got a nice suit. He'll write nice things about your company, and we'll give you a strong buy recommendation. Obviously, during the 90s, lots and lots of companies were coming public, and they were sort of indirectly promised that they got good buy recommendations from analysts. And then with respect to Facebook, I agree the problem is not with Facebook. The problem is not that shares went down, because that can happen in any IPO. I would just say that there is a problem with equal access to this information. When reports from analysts are issued by analysts who have special access to management, they can get information that is not really available to all investors. And when you see something like Facebook, there's a problem where you have multiple analysts from various underwriters who all cut their estimates from pretty much the same number to pretty much the same number. You have reports that people from Facebook may have indicated to them that they should go over their estimates. And meanwhile, the public gets sort of some vague line in a massive S1 amendment about, our subscribers are continuing to grow at a faster pace than our revenue. So the quality of information that's being presented to prospective clients of the underwriters just isn't on the same level as the information that investors would have if they have to dig through the S1 to try to discern what that means.
Dr. Sherman, you point out that in other countries that the retail investors do not engage themselves in the price discovery and price setting. That is restricted to, and I presume from your comments that you feel that that model is an appropriate way to set prices. But many countries have a specific tranche for retail investors in which they can buy at basically the same price. And can you comment about how effective and successful that is? Is that something that we should look at in terms of our approach to IPOs?
I'd like to see it considered here, especially for larger offerings. I think with smaller offerings, a lot of the smaller IPOs are already marketed more to retail. But for larger offerings, and I contacted Facebook, they never got back to me, but I tried to talk them into doing this. That way, everyone has an equal chance to participate. When I lived in Hong Kong, I went in and placed orders. All you needed was a Hong Kong ID number, and everyone had an equal chance. But without, the problem that's occurred with auctions is that when you get retail investor demand is very uncertain. You can get these floods of investors coming in and pushing the price up to unsustainable levels, and then people lose money, and then the retail go away again because they're scared of the process. So there needs to be some coordination, and we can easily then open up allocations and give everyone a chance without disrupting the process, which isn't good for anyone.
And one of the other aspects of the American model, for want of a better term, is the roadshow in which analysts are able to quiz management. As Ms. Baez suggests, it might be appropriate to consider making that much more accessible. And I think in Facebook there was a version put on the net, but it was neglected to have the questions of the analysts, which is probably the most important part of the demonstration. Is the roadshow process the best mechanism, or that you, in your view?
I think it's important, and I would like to see the question and answer filmed. If you look at why investors go to the roadshow, it's to see the management in action, to see how they respond to tough questions, to get a feel for the people, because you're not just investing in the idea or the product, you're investing or betting on the management team. And Facebook, their first day for the roadshow, replaced a lot of the Q&A with this 30-minute video, and investors were very unhappy about that. And by the next day in Boston, that was gone, because I've watched the online roadshows, but then you're seeing management scripted and rehearsed and filmed. It's just different to see them on their feet responding to questions, and retail investors should get the chance to do that.
Thank you. Ms. Trotter, we've got the Jobs Act now, and you suggested it's opening up new opportunities, but is one opportunity to, as been at least suggested in reports by the Wall Street Journal, to take a shell company effectively that is already sort of registered, presumably, and simply do sometime, and you're the expert, not I, but a reverse merger. And so you don't have to have audited, in some cases, audited financial statements, or you don't have to have the rigors of Sarbanes-Oxley, yet you don't go through the traditional IPO process of the book building, the analysis, or offering. Is that something that concerns you about how, either willingly or unwittingly this new act could be used?
Well, Mr. Chairman, many of the things that you just said about shell companies are in fact true. They were true before April 5th, 2012, and they continue to be true today. The Jobs Act didn't really change the dynamic with shell companies. They've always been a part of the system. They've always been subject to SEC review, so before they can register, they go through the same type of rigorous SEC review process where they have to provide disclosures to their investors. And in terms of Sarbanes-Oxley compliance by shell companies, they almost exclusively are smaller reporting companies, so they have already been exempted under Dodd-Frank from the internal control audit required by Section 404B of Sarbanes-Oxley. And so none of those aspects relating to shell companies has changed as a result of the Jobs Act.
But one of and this might be the most ironic aspect here of a Jobs Act, there's nothing in the bill that requires any creation of jobs to qualify for all the protections and all of the benefits of the Jobs Act. Is that accurate?
I think the premise underlying the IPO on-ramp is that, again, going back to the the competitive nature of the capital formation process and the fact that if you have an early stage company that needs to provide a return to its early investors who bet on the company when it was just an idea, that type of a company can pursue one of two paths. It can sell the company to an acquirer and be part of a larger enterprise and get absorbed and have redundant positions eliminated in the short term, or it can raise its own capital to be independent. And in raising your own capital to become an independent enterprise, you're going to grow the business. And when you do that, you're going to need more employees to help you run your growing business. So you're going to need to hire people. And in fact, if you can think of cities around our nation that are almost synonymous with certain major companies today, and yet those, in almost every case, they started out as fledgling enterprises that nobody would have guessed would have become household name companies today. So when you think about the connection between IPOs and job creation, you can just pick your favorite city, whether it's Seattle or Cupertino or Austin, Texas, and you'll think of a company that has changed the landscape of that city.
But specifically, all of the provisions of the Jobs Act can be accessed by companies who do not grow one additional job. They can avoid Sarbanes-Oxley reporting. They can do this until they get to the size of $1 billion in revenue. And it would seem to me that a company that has $1 billion in revenue could afford to have audit standards and could afford many other things which would protect whatever their shareholders. But the reality is that you don't have to have one extra job to be an emerging growth company. Is that correct?
Well, yes, sir. And several points in response to your very good questions there. The profit and loss system of the capital markets and our free enterprise system entails both profit and loss. This goes back to the distinction between merit regulation versus disclosure. And people now, in hindsight, talk about certain dot-com companies and how they are examples of bad ideas. Well, nobody knew for sure at the outset whether they were bad ideas. The investors had to choose and pick the winners and losers. And some of those companies are long forgotten, but many of those companies are around today and have even created new industries and changed the way that we purchase products. So that's one point in response. Another one on the issue of Sarbanes-Oxley compliance. Remember that the President's Jobs Council, headed by Mr. Immelt from General Electric, recommended a permanent exemption from Sarbanes-Oxley 404B compliance, the internal audit attestation requirement of Sarbanes-Oxley, for all companies below $1 billion in revenue. So the Jobs Act provision that gives this on-ramp of 1 to 5 years, depending on the size of the company, is much more limited than that recommendation from the President's Jobs Council. And again, any newly public company has up to 2 years under prior law before it has to comply. So it's really changing 2 to 5 in terms of Sarbanes-Oxley internal control attestation.
But one could argue, given the 2-year exemption for all companies before the Jobs Act, that the requirement to eliminate that for the initial public offering and for the 2 succeeding years might have been a little bit more, generous than was necessary. We already recognized in Sarbanes-Oxley that companies coming online, maybe not be as well prepared. Mr. Moskowitz, your comments about this whole area?
Well, with regards to the Jobs Act, you're referring, I believe, to some of the reporting in the Wall Street Journal about the Jobs Act, jobs-free companies, as well as some other articles that were describing lots of companies that were describing themselves as blank check companies or trusts and the like. And there's a quote in that article actually from the NASDAQ vice chairman who lobbied hard for passage of the Jobs Act and said he didn't think that anybody was thinking that this was going to be applied to reverse mergers and the like. And I guess I would say that we should be very careful about what the emerging growth company exemptions are being used for. We've seen trouble in China, for example, with sort of their reverse merger disaster. We had reporting in China and the accounting standards in China just aren't at the same level that ours are. And we saw when investors very suddenly realized this, very suddenly acted on this, starting in late 2010, shares of 93% of these companies fell, by an average of 50% for Chinese emerging growth companies. Any of them that wanted to raise capital after that point became very difficult to do that. You have companies that are presumably growing at 50 or 60% a year that have a PE of 2. And I mean, the only reason that happens is if people just believe that they can't trust any of the numbers coming out of China. If you're investing in a small Chinese company right now, the first risk factor you consider is whether or not it's a fraud. So I would just say that we should be very careful about how we don't want to move in that direction is all I'm saying.
Let me just, Ms. Trotter, an issue you brought up was merit regulation, which is, my understanding is on the federal securities laws, there is not merit regulation. Is that correct?
That's correct, Mr. Chairman. It's a matter of degree. When you require, for example, there are instances where disclosure can veer into merit regulation, depending on whether the requirement is simply to provide all investors with all material information about the company. That would be pure disclosure. Requiring specific disclosure about specific topics requiring companies to comply with substantive standards that are not simply about disclosing to investors all of their material information, then you're veering into merit regulation.
Well, my understanding, and again, it might be outdated, is that the SEC cannot refuse a registration because they object to a business model or anything else. They just can require you to spell out in excruciating detail, and that's not merit regulation. So it's setting up a sort of a straw man, I think, and saying, well, the fight is against merit regulation and disclosure. I'm for disclosure, but not for, we don't have merit regulation. Let me, Dr. Sherman, do you consider us we have merit regulation here for federal securities laws?
No, I don't think so, and that's very important. Having seen a lot of other countries, particularly in Asia, they give investors much less information and instead rely on metrics such as, has the company earned a profit for the last 3 years, and if not, you can't go public. And it closes out a lot of good companies and yet doesn't improve pricing because people don't have enough information to judge. So I think a strength of the U.S. is that we do have disclosure and not merit.
And because of that, there is a strong emphasis on very thorough disclosure. And as Mr. Trotter points out, it leads to long prospectuses. But my feeling, and I'll ask both you and Ms. Beyer, is that these prospectuses are read rather closely by very sophisticated institutional investors, in particular in preparation for IPO. So the information is not just gratuitous or ignored. I mean, frankly, if I was presented 200 pages, or I would quickly, Evelyn Wood would be proud of me. But when you have these roadshows, when you have this process of iteration, that these perspectives ultimately are very, very useful, I presume. Is that accurate?
I think so. I tell my students in my IPO and venture capital class that you get more information when a company does an IPO than at any other time. There's just so much in the prospectus. And when we do case studies, we go through the risk factors, and they'll have stories and extra detail. You find out a lot more about how the company does business, how the model works, from all of that detailed disclosure. And you don't necessarily have to read all of it, but you can look through and look for what you need, and hopefully it's there. So I think that's very important. I'd hate to see us loosen that.
Ms. Beyer, your comments.
Yes, as an institutional investor, we would read the prospectus cover to cover prior to meeting with the company so as to be able to use the meeting time most effectively. There's a tremendous amount of information available, and yes, it is written sometimes in arcane form, but it's tremendously important. And brings up another question about the Jobs Act, in that, of course, people now have, investors have less time to study the prospectus, given that they can now be filed confidentially.
Yeah, one of the, what's your reaction to the confidential filing? How is that going to practically impact an institutional investor like you, who is, wants to invest perhaps, but also, theoretically is helping to find the right price because you have all these details. What effect will it have practically on you?
I would say mostly institutional investors read the prospectus when it is in its final form. So for the most part, the confidential filing doesn't much matter. However, from time to time, the initial filing differs quite widely from the final filing thanks to commentary from the SEC. And investors learn a great deal in watching the changes. An example would be the company Groupon, which suffered mightily between filing its initial S1 and the final S1 as it became apparent that the relationship with the accounting rules was somewhat flexible. I would argue that that knowledge, watching that process, was very valuable to institutional and retail investors.
It just strikes me too is that, again, we have a system which is based on transparency, disclosure. Basic economic theory is perfect information, which drives competitive markets. And here we have basically said this is all going to be confidential until very late in the process, et cetera, and I don't see how that accomplishes the significantly informing investors, either institutional investors or retail investors.
Mr. Chairman, I would agree with you, and I would further comment that by allowing them to keep those facts hidden until later in the process, while concurrently encouraging research provisions that allow research during that period, we're actually asking investors to make their decisions based on opinion as opposed to the facts that they could have had. We have exactly flipped the arrangement I believe should be in place.
Mr. Trotter, comment, because I know you have a position on this.
Well, I guess what I would say is that the confidential submission process is based on an SEC, a historical practice that the SEC accorded to foreign private issuers. And so that's the genesis of the idea. Unlike in the case of foreign private issuers, though, in the case of emerging growth companies under the Jobs Act, they are required to provide the original submission plus all amendments that resulted from the SEC review process approximately a month before the IPO will price. And so all of the information that Ms. Beyer was referring to is publicly available in sequence, and investors will have a month to pore over all of that information.
Let me ask you another question, because there's the presumption that the Jobs Act proponents would argue that it reduces cost. In fact, there's estimates, I think, of 30 to 50% of the cost. I think that's what you were suggesting in your testimony. Where do these cost savings come from? Well, investment banking fees, you believe, will be lowered because there's not the requirement to do these elaborate road shows? Is it because information? Where are the savings coming from?
It's principally from two sources. Well, the data is based on surveys of pre- and post-IPO CEOs who responded to the specific proposals and provided estimates of how much cost savings they would recognize. But it's first through the deferral of the Sarbanes-Oxley internal control audit requirement, which again, for companies of this size, the President's Job Council recommended a permanent exemption from Sarbanes-Oxley internal control audit attestation. Okay. And then second, from the benefits available from the scaled disclosure system that the SEC has adopted for smaller reporting companies. And so in the case of, you asked about merit regulation versus disclosure. If you think about some of the disclosures that are required of very large enterprises and applying those disclosure requirements to much smaller enterprises. And I think it's worth noting that all of the companies that are captured within the definition of emerging growth company represent approximately 3% of total market capitalization. So there's a concern expressed by my fellow witnesses here that the definition is too broad, but I think you have to take into account the fact that that definition captures roughly 3% of the total market capitalization of the United States. So that's not a very large number.
This is one of those issues which depends on what you're measuring and what you're comparing it to. Mr. Moskowitz, I mean, my sense was that having limits of up to $1 billion in revenue captures a lot of companies in the United States.
Right, well,
not just in capitalization, but just sheer numbers of companies.
right,
And
well,
probably captures every potential IPO company.
so I'm not familiar with the 3% number, but that could be right. In terms of the IPO task force, they said it was 14% of companies, but in terms of IPOs, it's about 90%, maybe over.
So essentially, the world we're talking about IPOs, it's about most of them, 90% of them.
Right.
And the issue about cost savings, this goes to, and Ms. Trotter, I think, pointed out very, accurately. One is it's the internal controls, and two, it's sort of disclosure requirements that one could argue are more appropriate to large corporations, et cetera, but still it goes to this issue of disclosure and governance of the company. That's where the savings are going to be. Now, I don't think we'll see any savings from investment banking fees or from anything else. And does that, for the investing public, both the initial investors and the ongoing investors, does that make sense?
The investment banking fees are substantial for IPOs, and it would be nice if we could find ways to reduce that. In terms of the compliance costs, a company that is doing $1 billion in sales, whose market cap is 700 million, which is the upper limit here, can really afford to comply with Sarbanes-Oxley. My opinion.
Well, again, having participated with both Chairman Sarbanes and Chairman Oxley in the legislation, is that this was a direct response to abuses and lack of controls and those things that ultimately cost shareholders dearly when the companies cratered because they were not doing things the shareholders assumed were doing routinely, adequate audits. Well, I've had the rare opportunity to be able to engage with a splendid panel of experts. We've learned a great deal. Let me just simply ask, I think it's appropriate, if any concluding comments, Dr. Sherman and Ms. Byer, Mr. Trotter and Mr. Moskowitz, about the issue, advice to us going forward. Dr. Sherman.
I think, and I tell my students, that one of the great strengths of the U.S. economy really is the fact that we've focused on giving investors the information they need and letting them decide for themselves. So many countries take a much more paternalistic approach, and you end up losing a lot of great companies and funding a lot of bad companies that way. So I hope that the U.S. will focus on giving people as much information as possible and then having them take responsibility for their decisions.
Ms. Byer, please.
I would agree with Dr. Sherman's comments all the way along the way. I would say that the promise of a public offering spurs many individuals, at least all over the country, but certainly in Silicon Valley where I live, to try new ideas that turn into the large companies that never existed and suddenly employ thousands and thousands of people. The markets are tremendously important and mostly not broken. Mostly they suffer through swings according to risks in the marketplace. That said, I think there are a few changes that probably could improve the process, and again, I strongly recommend many aspects of the Jobs Act be reconsidered, as much of what it has accomplished is transferring risk earlier in the process from private investors to public investors, which, as you point out, doesn't actually create jobs.
One other thing too is, and this is the potential for not just the misallocation of resources, but for fraud. Does that concern you?
Yes. Certainly there will always be on the margins
yes.
some fraud, but we haven't talked in another time probably about crowdfunding, which is certainly very interesting, but also enables significant transfer of funds between informed investors and uninformed investors, or without any regulations around it. Because we have pushed back the size for which a company needs to reveal its information publicly from 500 shareholders to 2,000 shareholders, we will probably see much more activity on the secondary markets. And again, there are no requirements for information. And in fact, trading on inside information in the secondary markets is perfectly legitimate. So without going on too long, yes, I think we have some fraud issues coming.
There's a further complication which complicates our life in many different dimensions. That is, with the internet-based economy, these companies can be virtual and located far beyond the reach of anyone, which further makes it, particularly the crowdfunding aspect, a potential source of, get-rich schemes. And I have this terrible feeling that the first thing on the wedge paves will be, Congress just recently authorized this tremendous advantage to, please, take advantage of it. Your Congress, and I don't want to be too melodramatic, but that concerns me.
Of course, well, years ago, there was a cartoon in The New Yorker that showed a hound sitting at a keyboard, and the caption underneath was, on the internet, no one knows that you're a dog.
Yes, or very short. Anyway, Mr. Trotter.
The IPO task force came to its work with the view that the IPO process is critical to capital formation and particularly early stage investing, and that is all connected to innovation and job creation ultimately by the part of the private sector that really creates jobs. So that's our focus. And then just a couple of points again on risk. You can't remove risk from the system, because if you do, you remove the opportunity to make a profit. And so the solution is not to look for ways to eliminate risk from the system, but to make the system fair, and that's disclosure. But when you look at disclosure, what are you requiring disclosure of? Is it the type of information that the very largest companies in the United States have to provide, or is it the more scaled disclosure that focuses on what is material to an investor in an early stage company? And if you fail to recognize that distinction and apply very detailed disclosure rules across the board, then I think that you do have a system that veers into merit regulation of smaller companies.
Thank you very much. Mr. Moskowitz, you have the last word.
Generally speaking, it's not a good idea for investors, individual investors, to get involved in companies too early. The long-term sort of, after a very brief period of time of flipping stocks that occurs at the beginning of an IPO process, IPOs tend to actually underperform, and their share returns tend to be negative. The concern is that we don't want IPOs to be a process where companies are coming public with the intention of getting shares to favored clients of the underwriters so that they can flip the stocks over to unwitting investors who don't understand which companies are poor quality and which ones aren't. So I would say at a minimum, it's important that we have an equitable distribution of sort of useful information. I agree that these prospectuses are, they're very detailed. There's a lot of good information presented there. It's very difficult to go through them and find out, pick through it and figure out what stuff is really important. The Facebook example, it's really, you had to read between the lines to figure that out. And so I think at a minimum, it would make sense for investors to have access, the same kind of access that clients of the underwriters have. And then one final thing with regards to fraud, a lot of former securities felons have raised concerns about the Jobs Act. So I would just say that we need to think carefully about that. I have various recommendations with regard to crowdfunding. I can talk about them, but I could also just submit it to you later.
Thank you very much. I thank all of you for your testimony. It's been very thoughtful and very helpful. And my colleagues may have their own written statements, which they would be allowed to submit for the record. And I would ask them to do so before next Wednesday, June 27th. All of your testimony will be made part of the record. Some of my colleagues may have written questions. We may have additional written questions. We'll get them to you as quickly as possible and ask you to get them back to us as quickly as possible so we can include the record within a very short period of time and inform the chairman and the other members of the committee of this hearing. With that, let me again thank you for excellent testimony and adjourn the hearing.